Hello everybody and welcome to this short course on risk management fundamentals. My name is Shiv and I'm here to decrypt some of the buzzwords, some of the technical jargons that are used during the discussions around risk management fundamentals. So this first video is about understanding various ratios that are used when people talk about various risk management points. Alright, so the first thing is the price to earning ratio. What this is going to answer is whether this is stock which I'm looking at, it's a bargain or it's just a trap. That's the exact thing which price to earning ratio tells you. Now, before I tell you what a price to earning ratio is, I must tell you what is something called EPS, that is earnings per share. And as the name suggests, it is total earnings divided by number of shares. And when I say total earning, this is basically profits minus dividends that have been paid out, that divided by outstanding shares. So this is going to give you earnings per share, but keep in mind, share can be cheap or they can be very expensive. So this is not going to tell you how much is your earning by the amount of your investment. So for that you have to go back to the price to earning basics. So price to earning ratio is basically equal to the current share price divided by the EPS. So PE ratio is equal to current share price divided by EPS. So the price to earning ratio tells you how much an investor is willing to pay today for 1 unit of company's earnings. So if we talk about interpretations, then a high PE ratio can mean that the market expects a strong future growth. However, it can also mean that the stock is overvalued. And low PE can suggest the stock is cheap or that the investor is pessimistic about its future earning. So when do we use price to earning ratio? Basically, the best use of price to earning ratio, I would say, is to compare the company's current performance with its previous performance. So if you compare last year's price to earning ratio to this year's price to earning ratio, that will give you an idea of how the future trajectory of the company. But also you can use price to earning ratio to compare the companies within the same sectors, because keep in mind, price to earning ratio can be different for, like, what I mean to say is the normal range of price to earning ratio can be different for companies in different sectors. So let's say price to earning ratio of X is a good value for a company in let's say technology sector, but it might not be good for a company which is in FMCG sector, for example. So this is what price to earning ratio is used for, and this is one of the very basic, one of the fundamental ratios that is used in risk management. And now let's go to Yahoo Finance and see how the price to earning ratio look like for countries for the companies in various sectors in practice. So if you go to research, stock screener, and then so if you customize, right now I have this price to earning ratio in my grid. If you don't, then you can just customize and search up price to earning ratio and add it there. But let's see how it differs for companies in various sectors. So right now this is not filtered by any sector, but let's say if we just look into technology sector, you see the price to earning ratio of 45 is Nvidia, which is currently doing very well. It's a pretty good ratio, and if you scroll down a little bit, Apple is doing 35, and then Broadcom is doing 69.79, which is also pretty good. However, today it hasn't done very well. However, but in general, the price to earning ratio for good technology companies lies in this range. If you see down here, AMD has a price to earning ratio of 79.86. Now let's see some other sectors. Let's say we look into, let's say, basic materials. Now for basic materials, it begins to look like that, something in the range of 20s, 30s is a pretty good PE ratio for this industry, for this sector basically. And if we go to consumer cyclical and apply, still it's there are companies that have price to earning ratio of 48, but more or less in the range of 20s, with an exception of Tesla, which is giving 380 price to earning ratio. Let's switch to some other, let's say, real estate. Now, real estate on the other hand has a lower price to earning ratio, and there could be a number of reasons for a real estate company to have a lower price to earning ratio. It could be because they have a very high debt levels. The real estate industry is mostly capital intensive, and companies often carry very significant debt. And high debt levels can make a company look, it can look cheap as financing cost. They reduce net income. And also because they have a lot of debt, the real estate companies are very sensitive to interest rates. Now, if you want to see a very interesting thing, then just filter this down to financial services, and you'll see most of the companies have a very low price to earning ratio here. And that indicates that investors are paying less for each dollar of earnings, usually because they expect a slower growth or higher risk compared to other sectors. However, the absolute value of price to earning ratio in itself is not, it doesn't paint the whole picture. So this ratio can only be used for comparative analysis, comparing its own past performance to itself or comparing its performance with the peers in the industry in the same sector. So that was everything about price to earning ratio, guys. I'll see you in the next video. Bye-bye. So the next concept we're going to talk about is debt to equity. Now, that is the formula for debt to equity ratio, which is the total debt the company owns divided by the shareholders' equity. The debt to equity ratio measures a company's financial leverage by comparing its total debt to the equity, to the shareholders' equity. It is calculated just by dividing the total debt the company has divided by the shareholders' equity. For example, if the debt is 50 million pounds and the equity is 100 million pounds, then the debt to equity ratio is 1/2, which is 0.5, meaning 50 pence of debt for every 1 pound of equity. What it means for risk. So low debt to equity, which is like under 1, means It's less reliant on debt, lower bankruptcy risk in the downturns, but possibly slower growth. And high debt to equity, like over 2, it means more leveraged boost returns in good times but amplifies the risk if earnings drop. So as because even though you have better leverage, but the debt has to be repaid. You get more money to spend. You might grow faster, but then the debt needs to be repaid. So yeah, more leverage, which will boost the growth, but it also amplifies the risk. Compare to industry averages, capital intensive sectors like utilities tolerate higher debt to equity than the tech firms. And just like P ratios, the debt to equity ratios, or I should say good debt to equity ratios, vary widely by industry due to differences in the capital needs, the cash flow stability, and the business models. For example, for utility companies, something around 1.5 to 3, that's a good range for debt to equity ratio. And for banks or for financial institutions, something between 4 to 8 is a good debt to equity ratio, because for banks, leverage is the core thing to the operations. However, for real estate, it can vary from 0.5 to 2, because obviously real estate work on leverage as well, because they debt. They take debt to finance properties, and sometimes it can be 2 or more than 2 as well. On the other hand, things like healthcare, pharma, and consumer staples, anything between 0.2, 0.3 to 1, 1.5 can be considered as a good debt to equity ratio. Now, if we go to Yahoo Finance, and let me just remove this filter, and I have already added debt to equity ratio here. Now if we filter by industry, so apply equity filters, find sector, and let's see financial services. You will see these companies have huge debt to equity ratio. However, if you just filter down banks in the industry, you'll see range of debt to equity where this is something in a good range, and even these are fine. However, if you see these companies, they are Vanquish Banking Group PLC. They have a very high debt to equity ratio. Let's see, how about other industry sectors? Asset management. If you see asset management, they have the highest debt to equity ratio, but I don't know how much the good debt to equity ratio for asset management firms should be. Mortgage finance, same. And if we change sector to, let's say, real estate, again, see, this sector is also highly leveraged, so there'll be quite a lot of companies which has a very high debt to equity ratio and can be really risky, because if, let's say, the interest rate rise on the debt, it will be very hard for these companies to service their debt, and then they would possibly be looking to file bankruptcy. So remember, the debt to equity ratio for real estate companies should be, the good range should be around 2, maybe 2.5, but the high debt to, a lot of companies have high debt to equity ratio. But having said that, it also depends on because this is like not the absolute metric that you should go after, because let's say if a real estate company has assets which are not risky at all, let's say multifamily properties, which is very less risky, so it's okay for them to have slightly higher debt to equity ratio. But let's say a company which holds properties like hotels, for example, which can be risky. So I mean, because for hotels normally they have to put down a lot. I mean, it's riskier basically. So for those companies, you should be looking for debt to equity ratio which is more or less in the range, in the comfortable twos, or around two, that kind of range. And otherwise, it's just very risky, depending on how the interest rate changes. And also the debt to equity ratio is a very interesting factor for venture capitalists, because for early stage startups, if the debt to equity ratio is between 0.1 to 0.5 in early stages, then it's good, because that means that you are more reliant on equity rather than debt, and hence your idea has a lot of equity backing. But it depends on the stages of the startup as well. For example, early stage or pre-seed rounds, 0.1 to 0.5 is the ideal range, because of heavy equity reliance, debt payment could kill the business without steady income, and also because at this stage not a lot of banks would be willing to give the business any debt. And also when it's like the growth stage for the startup, then 0.5 to 1.5, stable cash allows a strategic debt for expansion without high distress or very high risk. But when you're past that stage, then once you're into the high growth or scaling fast stage, then anywhere between 1.5 to 3 is good, because that indicates aggressive leverage if cash flow supports it, but risky if the growth stalls. So if you're running a startup, try to keep your debt to equity ratio less than 2, because otherwise it will signal risk to investors and lenders, potentially blocking future funding completely. Okay, now let's talk about current ratio or quick ratio. So current ratio is basically the ratio of current assets that company holds, like cash in bank account, and short-term liabilities that the company has to service in a very short term, which is also called current liabilities. So the current ratio measures a company's ability to pay its short-term liabilities, which is mostly due within this financial year. And how do they pay? They pay it using their short-term assets, like something which can be convertible to cash within this financial year. And that's the formula that I just showed you, which is current asset divided by current liabilities. For example, let's say 500,000 pounds of assets and 250,000 pounds of liabilities yield 2 for the quick ratio or the current ratio, meaning £2 in assets per £1 owed short term. And what it means for risk. So if your quick ratio or the current ratio is above 1.5 or maybe 2, then you have a very strong liquidity and you can cover short-term obligations very comfortably, which is a very good, very comfortable range for a company to be in. But if it is below 1.0, then that is a very, very high risk of, significant cash shortages that would indicate potential distress sales. Maybe bankruptcy. And if it's too high, let's say greater than 3, then it might just raise question around the running of the efficiency of the company. It might signal that the company has too much asset lying around and the company is not putting it to good use. It may signal inefficient asset use, like excess inventory tying up cash. But like everything else, this also varies by industry. Retail tolerates about 1.2 to 1.5 due to fast inventory turnover, and services aim slightly higher current ratio. Yeah, okay, so let's move on to the next thing, which is interest coverage. It ties to companies' day-to-day operational risks. It tells whether the company will be able to pay the interest on the debt, and the formula for interest coverage is earnings before interest and taxes divided by interest expenses. So what does that mean? The interest, basically this ratio measures a company's ability to pay interest on its debt using the operating earnings. So whatever the company is earning from its operations, so this is like not, let's say if we have a real estate company and we are releasing equity from properties, then we cannot include that income. So this income has to come from operating earnings. So that's why it is called earnings before interest and taxes. And you take that earning and divide by the total interest expense which the company has to pay in that financial year, and that gives the interest coverage. So if we take an example of a company which has earnings before any interest or taxes of £500,000 and it has to pay an interest of £100,000 in that financial year, then it gives a ratio of 5.0. That means the earnings can comfortably cover interest 5 times over, which is a very good position to be in. And what does it mean for the risk? So if this ratio is like between 3.0 to let's say 5.0, it's a comfortable buffer, very low default risk, and even let's say profit dips, interest rate goes up, it's a very comfortable position to be in, a lot of buffer. Now if it is between 1.5 to 3.0, then it's considered a little bit marginal, vulnerable to earnings volatility or interest rate fluctuations. But if it is less than 1.5, then there's a very high risk of distress. It may struggle to service debt, and when that happens, then the bank might want the company to sell assets to cover up the debt. And however, when and the company may struggle to get new debt as well, because lenders, they often demand more than 2 to 3 more than 2 to 3 coverage, interest rate coverage ratio, and sorry, one sec. Lenders often demand greater than 2 to 3 of this ratio. Compared to peers, as a stable sector can tolerate lower ratios. Now how does this look in Yahoo Finance? Let's go. So in Yahoo Finance, you might not be able to find interest coverage, but yes, this is basically interest coverage, which is earnings before interest and taxes divided by the interest expenses. So I'll just move it up just after the market, no, actually before market cap, apply. So if I scroll to the left, yeah, that's the interest coverage. And if we just sort companies by market cap, we can see the biggest market cap in the real estate has this ratio at 2.76, which is fine, but as we go down, we can see there are companies which has a high ratio, and this can be considered risky. My bad. I mean, the higher the better. So the higher interest coverage, the less risky the business is. So this is a lot less riskier than this, and something which has a low income coverage can be considered risky investment. Alright, great. So the next thing that we're going to discuss after interest coverage is ROE or ROA, which is basically return on equity or return on assets. And this is a measure of profit basically. So return on equity is equal to the net income divided by the average shareholders equity, and return on asset similarly is equal to net income divided by average total assets. And sometimes these ratios can be multiplied by 100 to show them as percentage. So both these ratios show how effectively a company uses its equity and total assets to generate income or generate earnings. ROE measures profits per pound of shareholders' equity, and the formula is obviously net income divided by average shareholders' equity. For example, 5 million pounds net income on a 25 million equity is equal to 20% ROE. So 5 divided by 25, which is 1 by 5, and you multiply that by 100, gives you 20% ROE. So this is very strong for most sectors. Like 20% return on equity is it signals a very efficient management, a very aggressive investment, or the very efficient productivity, or whatever the company is into. They're doing it very, very efficiently. But this can be inflated by debt, because in this formula you have net income divided by the average shareholders equity. You can use a lot of debt to create ROE as well. For example, in real estate business, you have some money and then you leverage that money and borrow more from a mortgage company or bank, and then you can use that to inflate your ROE. And ROA gauges profits from total assets regardless of the funding source. So what that means is, let's say you have 5 million income on 50 million assets. So the company owns 50 millions of assets, and you produce 5 million pounds of income. Then that is basically 10% return on assets, which is 5 divided by 50, which is 0.1 multiplied by 100. It gives you 10% ROA. Better for comparing capital use across the firm, and aim ROA to be 5% to 10%, but depending on industry. And if you talk about the risk management angle, then the low ROE or low ROA flags a very weak operation. Like if it's less than 5%, then if you pair it with debt to equity to spot if the debt props up the return, then less than 5% is pretty bad. But yeah, even if, like, let's say it's very high, but you pair it with debt to equity ratio and you see, okay, the company is using a lot of debt, then maybe more ROA or more ROA might not signal very good operation. But for tech, you would normally look for a very high ROA, but industrial sectors have a very lean return on equity. So if we go to Yahoo Finance again and try to find ROE and ROA, let's say ROE, and just put that just before market cap, and then again put this next to apply. So let's see what let me just remove the sector filter first. Now we have ROE, and let me just do one more thing. Let me move market cap here, just so I can filter, or I can sort by market cap. So if you see, this Nvidia has done pretty well in the past 1 year, and it has produced an ROE of 107%, which is damn good, which is just pretty impressive. And if we just go a little bit to the right, and where is ROA? Here. Yeah, so again ROA has been pretty good as well, but if we scroll down to these companies, which is, see, Berkshire Hathaway has done okay in terms of return on equity, 10%, not bad. So this company, for example, has returned 2%, 2.61 on ROE. So that has done pretty bad. Now this company, for example, Philip Morrison International, has gone down to negative 132.39. So as you can imagine, it's terrible. So that was another measure for risk. Lower ROE and lower ROA means pretty bad management. Just stay clear from these investments. Can be very, very risky. But I mean, it's not absolutely true in all cases, but in most of the cases this is true. So now we'll talk about margins, specifically gross margin, net margin, and operating margin. So gross margin is basically revenue minus cost of goods, basically your expenses, divided by revenue. Net margin is basically your earnings before interest and tax divided by revenue, and operating, well actually no, earnings before interest and taxes is operating margin, and this is net income divided by revenue. Net margin is net income divided by revenue. So for example, a revenue of £100,000 and the cost of goods that was sold is, let's say, £40,000, and operating costs, let's say, is £30,000. Interest rates, taxes, approximately 10k. Then the gross margin is 60%, operating margin is 30%, and the net margin is 20%. So how do we use that to signal risks? Declining margins means, let's say, cost inflation, lost market share, or poor pricing. These are like early bankruptcy warnings. And if you look into various sectors or various industry sectors, then tech between 20 to 40 net margin, and retail is between 2 to 5% net margin, and you should be comparing trends for past 3 to 5 years. So that's how these gross, net, and operating margins are being used to signal risks. If they are eroding in past 3 to 5 years, then that is a very good signal that something is not working out with the company. So that will indicate risks. Now the next thing we are going to discuss is actually before that we should look into how the margins look like in Yahoo Finance. So if we go to Yahoo Finance again and look for margins, you'd see that we don't have operating margin here, but we do have EBITDA margin, which is close but not exactly the same as operating margin. Normally EBITDA margin will give you slightly higher values. So if you select all these and move it to the top right after volume, then we can see, we'll just play with these values and see how they look like. Volume, net, and EBITDA margin. So there, these are the new columns, and if I scroll it slightly to the left, then I have everything here. Let's see real estate, for example. So you'll see the gross profit margin is huge. However, when it comes to net income margin, it's nearly less than half of it, or sometimes 1/4, 1/5 of the gross margin. And that is because the real estate industry relies heavily on debt, so a lot of the profit goes away in servicing the debt. But let's say if we go to a different sector, say technology, then we'd see that the difference between gross profit margin and net income margin is not that huge. So that's because technology, in the technology company, the input cost is not as high as in the other companies. So if you see Nvidia has got a gross profit margin of 70%, however, the net income margin is also not too bad, it's 53%. Now, obviously, Nvidia will have to put in a lot of money in research and development, but the thing is that the technology company is not reliant on a lot of input costs like in the manufacturing sector or real estate. Now, moving on to PEG ratio, which is this. So PEG ratio is basically the profits to earning ratio divided by expected earnings per share growth rate in percentage. So the PEG ratio refines the price to earning by factoring in the expected earnings growth, while the PB ratio compares the stock price to net asset value per share. Both key for balanced valuation beyond the plain price to earning ratio. And let me just write down the formula for PB ratio as well. PB ratio is equal to current share price divided by book value per share. Now, what is book value? This is equity minus intangibles divided by shares. That is the book value per share. Now, what do these mean in terms of risk management? So the PEG ratio of less than 1 means potentially undervalued growth stock. So the value of PEG, if the value of PEG is less than 1, it is potentially undervalued growth stock. If it is about 1, that is fair value to the growth. And let's say if the PEG is greater than 1, maybe between 1 and 2, then it is overpriced, and it could be fine. I mean, the PEG value of more than 1, let's say 1.5, could be fine if the growth is accelerating. But if the growth is not accelerating, then that price means that it is overpriced. The stock is overpriced. And the PB ratio, which is basically share price divided by the book value per share, if that is less than 1, then that means it is trading below the asset value, and the value play, or it's a distress signal. If PB ratio is between 1 to 3, it's normal for most asset heavy sectors. It could be higher, but useful for banks where the asset dominates. PB ratio is useful for banks where the asset dominates. For example, if £10 share, and if you have a share which is priced at £10 and the book value is £12, then PB ratio is 0.83, which is cheap if the asset is strong. And again, in terms of risk management use, high PE plus high PEG is equal to growth hype risk, and low PB plus poor ROE or poor ROA is equal to just complete asset trap. So that is about PEG and PB ratio. But the question here is that if we had something like the PE ratio, why do we need PEG ratio? PEG is basically PE ratio, and G stands for expected growth in earning per share. One reason is that when we talk about P ratio, that doesn't tell us whether the ratio is good, because it varies, whether the ratio for a particular stock is good across industries or across sectors, because the ratio can be different for different sectors. So how much is a good P ratio can differ by sector. So what we do is we take the P ratio and then divide it by expected earnings per share growth rate, and that gives something which is standard for every sector. But this will be mostly true for sectors which is not. So number one thing should be the company should be profit making because there is no expected growth rate for loss making company. Secondly, it should be those companies where the book value is less important and the growth rate is more important, like investment companies. For investment companies, we'll look into PB ratio because they are mostly driven by book value rather than the price to earning ratio. Now if we talk about PEG ratio, then simple indicator is if the PEG ratio is approximately equal to 1, that means the stock has a fair value, and if it is less than 1, then assume that it's a bargain, so you go ahead and buy. If it's greater than 1, then just sell. And if you go to the Yahoo Finance, I just added PEG here. So if you search up the columns, it will be under price divided by earnings to growth ratio, and you see that Nvidia is still on the top, which is 0.89, so it's a strong indicator to buy. However, there are lots of, so now the problem with some of these PEG ratings is that it's very hard to reliably predict growth, and the growth forecast can be wrong, and hence the PEG ratio can be incorrect as well. So that is some reason where the PEG rating can be incorrect. But right now, if you see PEG rating of minus 13.28 for Intel Corporation, and there are Microsoft is greater than 2.3, so which is indicating a sell. However, the stock is doing okay right now. So like every other ratio, this is not like 100% accurate, works all the time kind of ratio, but it's a good indicator of how the company is performing. So next we are going to talk about cash flow ratios. So the key cash flow ratios are these: cash flow coverage ratio, operating cash flow ratio, cash flow margin, and free cash flow free cash flow yield. So what are these cash flow ratios used for? Cash flow ratios assess whether a company's operations generate enough actual cash, not just accounting profits, to cover debts, to sustain growth, and to avoid any kind of distress whatsoever. They reveal earnings quality beyond the price to earnings or margins discussed earlier. So basically, they will reveal whether the company can run smoothly and comfortably. So the cash flow coverage ratio, which is the first one here, is basically the operating cash flow divided by the debt, or the total debt that the company needs to service. And for this one, ideal range should be 1 to 1.5. And if it is less than 1, then it signals repayment risks. So less than 1 will mean that the operating cash flow is a lot less than what you need to service the total debt of the company. So ideally it should be higher than 1, which will signal that okay, the operating cash flow is good enough to service all debt, and maybe more. Now the operating cash flow ratio is basically operating cash flow divided by the operating cash flow divided by total liabilities. So now for this one, if it is greater than 1, that will suggest a strong short-term liquidity. It's similar to the cash flow coverage. If it's greater than 1, then it suggests a very strong short-term liquidity. Now cash flow margin is also related to operating cash flow, but the formula is operating cash flow divided by the revenue. So cash flow margin, if it is between, let's say, 10% to 20%, what that suggests is that the company has a very efficient cash conversion. So it has a very low flags or low capex, capital expenditure drains. So 10 to 20% is a good range for this thing. Now free cash flow yield is equal to free cash flow divided by total market cap. Now this one, if it is between 5 to 10%, then that will suggest that there is some excess cash for dividends or excess cash. So this excess cash could be used by the company for dividends or could be used for growth. However, if this is negative, then that will suggest it's just barely survival mode. So why they matter for risk? So unlike net income, cash flow are the cash flow. It cannot be easily manipulated because spot firms burning cash despite profits, like high growth startups, they grow and find fundings and they just burn the cash from fundings. But here it tracks trends quarterly via the cash flow statements rather than the income. Now that's one of the factors which is very important, and it will basically try to assess whether the company's operation has generated enough physical cash, actual cash from its own income. Like for example, people argue that OpenAI right now is using up a lot of raised fund, and the actual cash flow coverage is pretty low. So yeah, that is everything I need to cover in this video. I will follow this video with another one where I will discuss some advanced metrics and advanced ratios or indicators, which is also used for risk management. But for this video, I think this is enough. I'll finish off this video. I hope you like it, you found it useful. Thank you everyone. See you next time. Bye bye.